This is the Properties and Pour-Overs podcast. My name is Adam Colburn, and today I have a co-host, my man Nathan Chapman. What's up, Nate?
Hey Adam, thanks for having me on.
Absolutely,
Thanks for Brian
man.
being here.
For sure, yeah. And so today we're going to be interviewing Bryan Maddex, fellow Subto student and mortgage broker. And so, Brian, can you just tell a little bit about your background, where you're located right now, and kind of your experience in the lending industry?
Yeah, so I'm in Charlotte, North Carolina, and I've been lending since 1997. I worked at Nations Bank at the time, way back. Did my first refinance when rates just got under 8%. So, these last 2 years have brought back a lot of memories about rates kind of up in that level.
Yeah.
I've probably lent, I don't know, well over $1 billion in my career.
Wow.
In 2013, I switched out of the retail banking world and I joined the mortgage world. And then this year, I went from being a banker, right? So I worked for an independent mortgage bank, which is all your big Movement, Atlantic Bays, those type of companies. And I went to be a
Mhm.
broker. So now I have access to over 220 lenders. And I'm kind of drinking from a fire hydrant because I just made the move almost exactly 4 weeks ago, and I just have access to so
Wow.
much more. It's a lot. It's a lot of access to products. So I'm kind of feeling like a new guy again. But I'm
Yeah.
certainly not a new guy since I've been lending for almost, 27, 28 years, a long
Wow.
time at this point. So,
Yeah, ton of experience. Well, then perfect credibility piece for what we're going to talk on, right? Because you would know better than most on the situation, and especially with a lot of us creative investors within Sub2 and just in the real estate investing community. Um, One of the biggest objections that we get from sellers is the whole DTI issue. Like, am I going to be able to afford another mortgage if you guys take over this mortgage and that
yes.
remains in my name? And so I know you made a post a few days back about some specific changes. Do you want to kind of expound on that and what are those new changes?
Yeah, and I don't know exactly how new the changes are, but they have definitely been tweaking guidelines. And that's what Fannie, Freddie, FHA, they continually tweak the guidelines to their benefit, obviously. They
Of
want to
course.
be profitable, they want to be responsible, they want to put people in good situations, and they're always kind of updating guidelines to see how it's going to best fit everybody. And so, one of the things I had heard a lot, and I see on message boards about subject to financing, is all you need is to prove 12 months of proof of payment that a third party's making a payment on a mortgage, and then you don't have to count it against your DTI. I've even heard people say you can make it go get away or you can erase it from your DTI, and that is not the case. So what has changed is all of the agency guidelines, so Fannie, Freddie, FHA, VA, USDA, they've all changed their guidelines that say if somebody else is making the payment for you, they have to be it has to be considered a contingent liability. So what that means is, Adam, if I co-signed on a house for you to help you qualify, and
Right.
you're making those house payments for 12 months, after you make 12 months of payments, it no longer counts against my debt to income as a co-signer on your mortgage or a co-borrower. So
Sure.
that's a contingent liability. So no longer can you just have proof of 12 months payments from any random person making those mortgage payments. That has to be an original co-borrower. They have to be on the note or on the mortgage with you for that consideration for the 12 months proof of payment. So my post, what I tried to do is kind of outline a bunch of different methods that you can help a seller. And I'm a mortgage lender, so I always call them my buyer, but it's your seller, someone selling a
Sure.
house to you. I'll come in and I'll partner with you. Once you've got them sold on the idea of subject to financing, I'll partner with you to help them get qualified for their next house.
Yeah.
So I don't talk people into it, but
Right.
I will help take away their fear and their objection of, well, hey, this mortgage is going to stay on my credit. That means I can't buy anything going forward. And you absolutely can under certain circumstances. So I kind of broke it down into timelines. Are you looking seller? Are you looking to buy right away? So in the next 1, 2, or 3 months, or are you looking to buy a year out or more? There's no in between. There's no 6, 8, 10, 12 month, less than 12-month options, because the two strategies that help the most is going to be either a lease agreement on your existing house. So let's say, Adam, you're buying my house. And the way I need to offset that mortgage payment is by extra income. So instead of you buying it from me right away, Instead, you lease it from me, and then you do a lease option to purchase. I would recommend a 3-year. That's a very standard lease option purchase contract. You're going to negotiate your sales price, your down payment, your terms. All of that's going to be negotiated in your lease option. So if I'm now a buyer, right, because I'm selling my house to you subject to, I need to offset that mortgage payment. So you're going to rent the house from me. We're not making up anything. This is legit, real lease. Security deposit, monthly rental payments until I can find a new house to go purchase. Now, once I go find a new house and I purchase it, after that, and I would always recommend, 2 to 4 months after I'm in my new house, that's when you execute your lease option to purchase. So now I'm no longer the owner of my old house. You are, because I've signed the deed over to you. I'm off title. Now the mortgage remains in my credit. It remains in my name. So the way that I can buy my next house is if Adam, I am now the bank and you're the borrower. So we're gonna suggest doing a wrap mortgage or a mortgage that's around my mortgage. So that's why it's called a wrap. It literally hugs my mortgage, right? So your wrap mortgage, you're the borrower, I'm the lender. I need that income for at least 12 months before it counts as income for me going forward. So that's why I said you either have to do a lease agreement right away or you have to buy after 12 months. Because if we do a wrap mortgage, that wrap mortgage income, it creates notes receivable income. It's not going to count to offset that underlying mortgage until there's a 12-month proof of payment on that. So those are our kind of two main strategies on how do we help someone sell and overcome the objection of, hey, this loan's going to stay in my name and it's going to affect my debt to income.
Absolutely. And so, because we've used the lease option strategy before with people, especially if they're trying to purchase a home right away.
Right.
And so are you suggesting with the 3-year lease option to actually perform the full 3 years or just wait until the 2 to 4 months after they find their new home and then push that forward and go ahead and perform on the purchase?
Yeah, so the beautiful thing about a lease option is you can execute at any time. You have up to the expiration of the lease option. So if you do a 3-year lease option, you have up to 3 years to execute that lease option. So I'm not suggesting that you should go a full 3 years. But when Fannie and Freddie look at anything, they always consider continuance. Is this likely to continue long term? And because everything in Fannie Freddie guidelines is a 3-year mark, make things fit what Fannie and Freddie are used to. So they're used to seeing things like if you're going to retire, if you tell me you're getting a mortgage and you tell me, Bryan, I'm going to retire in 2.5 years. Guess what? Your income is not going to continue. I might not be able to lend to you because I can't ensure that your income is going to be there for a 3-year continuance. So I would recommend you do the 3-year lease option because it's kind of standard protocol to have things go out 3 years, but then execute at any point. I don't suggest executing right after I would, if I'm the seller, right? Don't execute right after I sell or I buy my next house. The reason I suggest that is banks are auditing more and more of the closed loans that they get because A, they're not that busy. They're not doing nearly the number of purchases. I saw a stat that we're on track to have as many home closings this year as we did in 1978. That's how far back you have to go to see how slow of a market we're in. That means mortgage companies have lots of operations staff sitting around twiddling their thumbs. So what do they got to do? Let's audit some loans, right? So they're auditing the loans. And if you execute that lease option 30 days after I buy my new house, it's going to get audited and they're going to say, okay, this person qualified with a lease and let's look up that house. Wait, they don't own that house anymore. If you don't own the house, a lease is not valid. You can only lease out property that you own. So my suggestion is that you wait 2 to 4 months, hopefully more like 3 or 4 months, because what we don't want to do is call attention to subject to financing. It's not illegal. I'm not an attorney, so I'm not giving legal advice, but as far as I know, it's not illegal anywhere. I always have to put some stipulations on, right? Especially when we're being recorded and going on YouTube. So we want to do things real, and we want to have the bank be able to audit the loan and see everything is prim and proper. The more often they see, wow, that house was sold, the more they're going to start putting some doubt into some of these transactions. And we want to protect, as subject to buyers, we want to protect our ability to do purchases in this manner because it's a creative financing solution. It's not illegal as far as I know, but it's not mainstream. And it's not encouraged by Fannie or Freddie or anybody, right? So if we
Definitely.
want to protect our way of doing business, we don't want to call attention to the types of transactions we're doing. We also, as subject to buyers, we want to protect our sellers, because the more often a seller comes back and tries to buy a house and they can't, the more they're likely to go to the media, to their Congress, and we're going to see more and more guideline changes to restrict our ability to do subject to purchases. So to protect our way of doing business, we've got to try to do what we can to protect our sellers, so that they're able to keep buying. That's why that wrap mortgage, I think, is so important. Now, that's current guidelines of the wrap mortgage, 12 months income. We can see that change, right? Guidelines change all the time. We started off with guidelines change all the time. So right now, it's how we think we can go forward and protect our sellers' ability to buy houses in the future.
Yeah, no, that's awesome. That's really good information. I know specifically for FHA loans, those can be more challenging than most to get through on a subject to transaction.
Yes.
Does this wraparound mortgage help solve that issue, or is it something specific about FHA that makes it difficult for another for a seller to go and buy out another loan if they wanted to use FHA again?
So it is very tricky because you can only have one FHA loan at a time,
Got it.
right? There are some exceptions to that rule. If you inherit a property, if you expand your family size and you've outgrown your old house, or if you move more than 100 miles for work. And that
Right.
for work is a very important part of that guideline. Because if you're working from home and you move more than 100 miles, you didn't move for work. You moved because you
Right.
wanted to
Home
be
is
in a new
still home.
location.
Yeah.
Yes. So if you're not moving, and so most people, the way they qualify for a secondary FHA mortgage is they've moved more than 100 miles away. Every once in a while, it's because of the family, dynamics changing. But for the most part, it's going to be that move 100 miles. The other thing is a lease agreement. When you're looking at an FHA loan, the only way to count rental income to offset the FHA mortgage is if you have 25% equity in your exiting property. And a lot of the subject to transactions that I'm seeing, oftentimes the seller is very light in equity, and that's one of the main reasons they're considering a subject to sale.
Sure.
And so if you don't have 25% equity, the lease agreement isn't there to help provide an offset to your current situation. So the hardest transactions for subject to transactions to work is when you've got an existing FHA loan and you need a new FHA loan. Now, if you're existing FHA and you can go conventional, there's no problems, right? It's when the new loan is FHA, we have to see that exiting property have 25% income. And if the existing loan is FHA also, we have to have moved 100 miles for work. So generally speaking, I'm going to say that FHA financing and subject to financing are oil and water, and rarely do they mix. In certain circumstances, you can make it work, but I'm going to tell you it's probably very rare that you can make that work.
Sure. Yeah, and I've heard from other investors as well that they have challenges with title companies even wanting to do those transactions, and they're having to self-perform and do those kind of things. I guess it kind of goes along with these same guidelines is why those loans are more difficult to do. Just adding another layer of difficulty. Not
Right.
impossible, but definitely makes it more challenging. Okay.
So my encouragement would be, if you got to wait at least 12 months, the number one reason people go for FHA is credit score.
Okay.
Oftentimes, we've decided that FHA is the best for our buyer because they can't qualify for a conventional loan. Now, FHA is a great loan product, and I'm not trying to smear FHA as a nasty or a bad loan, but there are things about FHA that make it sometimes less appealing than a conventional loan. And
Sure.
so, subject to financing, especially if we've got to take time out, let's work on credit. Let's work on qualification so that when the time comes, we're able to go conventional and make everything a little bit easier.
Yeah, no, that's great. And I think that could be another kind of tool in our tool belt if we are dealing with FHA sellers, is that, hey, if we take this over, give them the full expectation that you can't go buy a house for 12 months, and why don't I get you plugged into a credit repair program or something like that to help you push along, that we can then send them to guys like you that can help them get conventional financing, and then we kind of skirt the whole issue altogether with the FHA.
Right. And that's really being a coach and an advisor, right? I mean, when you're doing a subject to transaction, everybody should win. And we're doing it to solve problems. We're doing it to solve their problem of being able to sell the house traditionally. We're solving our problem of maybe needing as much money down, or being able to qualify as an investor. Or maybe we're looking to, we're solving some other problems. But generally speaking, subject to transactions should benefit everybody, right? There shouldn't be a loser
Absolutely.
in this transaction ever.
Yeah. No, that's so good. Nate, do you have any
Also,
specific questions? Yeah, go
I
ahead.
was gonna say also ideally too, you're servicing their loan too should increase their credit score as it has several months of them making their payments on time too. I was also going to ask Brian, there's that 3 to 12 month mark where you're kind of in the no man's land there between the lease option and the when wrap takes over. Is there anything, I know it's not ideal, but is there anything stopping us from creating a lease option and maybe executing, if they're a little bit after the 12 months, say they're not sure if they want to buy it, month 11 or month, 13. Is there anything stopping the lease option from extending?
No, especially if you've written it for 3 years, right? At any point, and if you're comfortable as an investor leasing that property, you've got, don't want to say ownership rights, but you have a vested interest in the property if you have a lease option, right? And so with that lease option, hopefully you did it the right way and you're protected. You're the person that gets to buy this house. So many investors, they may not want to be the renter of a property. But again, if it's solving your need as an investor, maybe you're converting the house to a co-living or a pad split model, or maybe you're doing short-term leases or rentals. And so the lease, it's really going to cover the mortgage payment ideally. You could do that for 2 or 3 years. You don't have to be on title for a lot of the things you might want to do with the property. So I think that that's just a communication thing between the buyer and the seller of expectations on timelines. How long can this lease option, go forward? And I think as long as you're communicating well intentions and you're on the same page of what everybody's trying to get out of this transaction, then there's no downside at all to doing a lease option for a full 3 years. And if you want to do a 5 year or lease option can be as long as you want it to be. So obviously seek real estate attorney advice to make sure you're doing it the correct way. I know a lot of states have some really weird lease option things. In North Carolina, I've heard you should not do a lease option and a lease at the same time, because if you mess up part of it, you're liable for triple damages in North Carolina. So definitely be working with a very experienced real estate attorney to make sure all of these things are done proper. And again, in the subject to or in the mortgage world, we don't want to be faking anything. Everything should be stand up. It should be very legit.
Yeah.
Right.
No, that's great. And I love the lease option strategy, but correct me if I'm wrong, but isn't Texas the only state that doesn't allow lease options? Or
That
they're
is
more
not my
difficult?
lane, my friend. I
Okay.
can't
Yeah.
answer that question.
Sure, no problem. Yeah, because I've heard people having challenges with that, and you'd have to do some other. But I guess the wraparound mortgage would still solve a similar problem. They would just still have to wait the 12 months to show that income receivable. And when you
Right.
mention income receivable, does the full 12-month payments that I've been making for that year then count after the first year, or does that when the month 13 is when they can start showing that income is coming in?
So that month 13, so I have had a client that was receiving notes receivable income, and they wanted their borrower to pay 3 months at the same time. It's not 12
Right.
payments, it's 12 calendar months of, and what
Mhm.
they wanted, why they're looking for 12 calendar months is consistency. They want to see payments are made on time.
Right.
Right. So Fannie and Freddie, again, they're worried about continuance. So mortgage underwriting is all about looking at the past performance to predict the future. And
Sure.
so it's not, did you get 12 months worth of payments in your pocket in 2 months or 3 months? It's more about, was your borrower consistent? You cannot have late payments in that 12 months. We want to see that those payments came in on time for 12 months. And
Yeah.
now it's considered stable income, and stable income is what we lend on.
Right.
So we need to see that full 12 calendar months worth of payments on time, month 13. So you could probably go under contract on the 11 and a half month. And then a condition upon closing would be receiving that 12th payment. So you might be able to close 5 or 10 days after you've received that 12th payment. So you can
Sure.
kind of skirt that a little bit if you do a longer contract on the purchase. The
Right.
other thing that we haven't talked about, the notes receivable income, and I have not tested this. I don't like to give advice when I haven't seen it gone through underwriting directly.
Of
And what I
course.
have not done is I've done notes receivable income a number of times, but always was the lender, they were receiving the cash in their own bank account, and then they were paying their underlying mortgage. And I know a
Yeah.
very common practice is when you buy something subject to, you set up a third party servicer that
Correct.
takes the payment to the servicer of the mortgage directly. So it
Right.
doesn't hit my bank account, but it benefited me because it paid a mortgage I'm on. So my gut tells me that it will work if I can prove that my mortgage in my name received 12 payments on time. I think and I feel that that does benefit me, so that will count as notes receivable income, but I have not tested that. So that
Yeah.
is a little cautionary asterisk between the notes receivable income.
Sure. Yeah, and I feel like most of us investors we like the third party servicer because it's a cheap alternative from us having to just spend the time to remember to go in and pay, but also the potential risk of the sellers just pocketing that money and then not paying the mortgage, which I mean
Right,
in turn would hurt them because the loan is still in their name. But in this
right.
scenario, that if we need to show 12 months receivable and that it's going towards that mortgage, if seller Bob is just going and paying off his car payments and not paying the house, then we're kind of stuck in a tight spot.
That's bad. So, one thing that I have thought of is what if you opened an account? I mean, when you purchase a home subject to an existing mortgage, financially, you're getting into bed with this person, right? We
Right.
have to have a level of trust and understanding of each other. So, with that in mind, what if for underwriting, we have your money for your payment go into a joint account and then draft out of that joint account to pay the mortgage payment? So instead of using a third party servicer, or you could still use a third party servicer, you just have it draft out of a joint account that you both have access to.
Right.
And maybe you don't, lots of banks won't allow overdrafts. You could have your timing so your money goes in the day before it's supposed to be pulled out. So that's just an idea. If the 12 payments to the servicer directly doesn't work through underwriting, and I hope I
Yeah.
get to try one of these transactions soon.
Hmm.
But I have not tried it. So I want to experience and I want to see that it works so that I'm more
Yeah.
confident in this advice. But there's always another way. And it might be a little more manual or it might be a little uncomfortable because you're creating an account relationship with somebody that you're buying from. But it's important to both of you that this payment's made on time forever, right?
Of
So
course. Yeah.
if we got to do things to protect that seller and have them be able to, then we got to do it that way. So that's just one idea is you have the money land in a joint account and then go forward from there. That's something that you could always look at doing.
Yeah. No, that's really smart. Love that. Nate, do you have anything
Brian,
else?
yeah, Brian, I had a question. You mentioned or you touched on earlier that these guidelines may not be as new as you noticed it not too long ago. But in either case, I was wondering, have you noticed any changes on when you're working with uh, investors? Have you noticed any changes of notes being called due or any like an influx of, borrowers complaining that they can't buy a new home because there are DTI problems, anything like
Yeah,
that?
one of the communities that I'm on Facebook on, I do see, I don't know how often because I'm not in this, unless I'm tagged, I don't go in there every day on all the posts, but I have seen an uptick of people who sold their house subject to raising their hand saying, I can't get my next loan. And when we've dug in, they didn't do lease agreements to help them buy right away. Sometimes they didn't do a wrap mortgage. I don't think you can go back and record a wrap mortgage after you're done, right? I
Right.
don't think you can go back in time and get that recorded. I think if you record it today for a house you bought in 2022, I think there's going to be a lot of suspicion and a lot of questions around, wait, you bought this house in 2022 and you recorded a mortgage in 2024. This doesn't make sense, right?
Yeah.
Underwriting, a lot of times they're looking for what makes sense and doesn't make sense. So I've not seen an uptick in notes called due from my perspective. If you go on Bigger Pockets, there's going to be some additional people saying, hey, I've had a note called due. And the majority of the reason is right now, there's less mortgages, there's more auditing. I've seen people have notes called due and they have said, and I've seen it online. I haven't had any of my clients or anybody that I've associated with ever come to me and tell me I had a note called due, right? But I've seen that sometimes You just work out with the bank and say, hey, I'm making payments. This is what we did. We're on time. We're good to go. And I've seen some people allowed to continue to make payments on that mortgage, even though the deed isn't in the underlying borrower's name anymore. But I've seen on bigger pockets the opposite. You've got 30 or 60 days. You got to pay this puppy off, right? Guidelines. So I did a post with Pace. I want to say it was August 2023, and we talked about the 12-month proof of payment. And then about, I don't know, it was like December, I put a post on his group. This post that I just reposted in July, I posted an original post in December because I had gone in and I looked deep on guidelines and saw that all the guidelines in the December timeframe no longer allowed for the 12-month. Anybody can make that payment work. So in December, once I noticed it, I put a post out there. And then in July, I just figured it was time to update it and put some new, fresh material into that post and hopefully some tips to help out, subject to buyers.
Yeah, absolutely.
Definitely very helpful. Is your clientele, is it mainly investors, or do you do mostly homestead buyers?
So yeah, I would say probably 70% of the clients I work with are buying properties for themselves. And then maybe 30 or 35% of my clients are investors. I do most of my networking with real estate investors. And I am a real estate investor. I had my first rental property in 1999. And, we were house hacking. The term was not around in 1999 as house hacking, but that's what we were doing. So we were making money on the house we lived in, and that's how we were able to buy our first property, my wife and I. Right now we have 5 short and midterm rentals. And I haven't actually done a subject to purchase, but I've helped lots of subject to sellers buy their next home, right? So I've been around the community for a long time, and as an investor, I read into guidelines a lot because I'm trying to find an advantage for myself and for my clients, because most of my networking is with real estate investors.
Absolutely.
Right. Yeah. I didn't have any more questions. I don't know if you did, but I was hoping people could find a way to
just Bryan, how can people connect with you if they're working with a client, or if they themselves are looking for a loan? Like, what's the best way to reach out to you?
Yeah, I am not a hidden guy. You can Google my name, Bryan Maddex, Bryan with a Y, Maddex with an EX, and you'll find my phone number. You'll find my website. You can go. I don't know if my website has a Calendly link right now, but it will shortly. Go schedule an appointment or hit me up on Facebook, right? So find a way to communicate with me or find my cell phone online. I don't generally just put it on YouTube because I don't want scrubbing to up the spam calls, but it's not hard to find if you put a tiny bit of effort in there.
Sure, yeah. And then are there specific states that you are lending in currently?
So if we look at homeowners, there are, I just had this list up. There are 28 states that either myself or my team can help people buy in. And if we're doing a DSCR or a business purpose loan for investors, there's an additional 16 states. So I have access to lend currently in 44 states. And they're all the big states. The small states, no offense to anybody that's in South Dakota, but that's not a state that I'm licensed in right now. If I got a number of people coming to me from South Dakota, I would ask my company to get licensed, but there is a cost for the company. There's a cost for the branch, and then there's a cost for me. And some states, it can take upwards of $5,000 or $10,000 to get licensed in. So I don't want to be licensed in all 50 states because that's a tremendous amount of money. But there's, the biggest 28 states I have access to help people out in.
Love it. Well, awesome, Bryan. Really appreciate your time. That was a wealth of knowledge. I think this will be hugely valuable for folks that are looking into Subtos and how to best help and serve their sellers. And so thanks for your time today.
Man, it's my pleasure. If I can help you guys out in the future, let me know.
Absolutely. Well, thanks so much, guys, for watching. Until the next episode, we'll catch you later. Peace.